In December 1940, Henry Morgenthau walked into George Marshall's office. And George said, "Thanks for dropping by, Henry." Henry said, "No problem." George said, "Well, here's the list." Henry took a look at the list that George handed him and he said, "No problem." And George said, "You sure?" He said, "Yeah, Mariner and I have worked it all out." Of course, Henry Morgenthau was Secretary of the Treasury. George Marshall was head of the Army, equivalent to head of the Joint Chiefs today. And Mariner was Mariner Eccles, who was chairman of the Federal Reserve. And what they were talking about was funding the massive spending by the government. Because what the government is running today is a wartime economic policy, no different than we ran during World War II. In that type of policy, a government runs massive deficits. The central bank monetizes those deficits while controlling interest rates at a low level. And there is ensuing inflation that inflates away the debt. You can see this has happened during every major war that the United States has had, going back to the American Revolution. And we expect that inflation, which will have a pullback over the next year as supply comes on and the Federal Reserve slows monetary growth, will reaccelerate later this decade as the government continues to spend in what will be a guns and butter policy that will be necessitated by both U.S. demands for domestic growth and a rejiggering of how the economy is run so that the average person can benefit, and a rejiggering of the whole international relationship set that reorients towards a Cold War with China and Russia. And make no mistake, we are in a Cold War, and that is going to have significant implications for how we do things with China and Russia and how Europe and Asia align themselves. Okay, there's our normal legal disclosure. And now that you've read that, we will go on to the Fed. The Fed controls the spigot that basically accelerates and decelerates the economy. It doesn't control the underlying speed, but it does control how things are accelerated and decelerated. The speed is controlled by the federal government and how the government sets up the rules and where it spends its money. And where is the Fed? The Fed is at the point where it is going to stop putting money into the economy. Classic.
This is do you want me to put it on? Do you want to hear this?
The Fed is at the point where it is going to slow monetary growth, and it is going to take money eventually out of the economy. Both of these will slow down the economy and have an impact on various industries disproportionately, just like their easy money policy had a disproportionate impact on various industries as well as asset valuations. So as we've said, the Fed's policy looks very much like what it ran during the 1930s and 1940s. Here's the quantitative tightening it would have led before the last recession. It would have led to recession anyway. We were predicting a recession in 2021. It just came a year early because of the pandemic. And by the way, here is the policy that the Fed ran in 1936, 1937. You can basically take the two charts and superimpose them on each other. They are that close. And in fact, the quantitative tightening in 1936-37 ended up in the 1937-1938 recession within the Depression, after which the Federal Reserve never tightened monetary policy like this because of World War II. At best, money treaded water, and then the Fed threw more money into it, as the next chart shows. And as you can see, that little tightening in 36-37 looks like nothing compared to all the money that was thrown at the problem afterwards. And if we come back to today, what do we have? We have what appears to be a similar pattern developing. The Federal Reserve here has gone through quantitative tightening and monetary growth has taken off again. money supply more than doubled over the last couple of years. And if we look at this from a total perspective, the federal government issued about $6 trillion in debt over the past few years, and the Federal Reserve issued $5.6 trillion in M2. Effectively, the Federal Reserve monetized the federal debt. And any time a central bank does this, this leads to inflation. There was a very prominent example of this in the 1920s that led to the collapse of the French franc. Here's the US budget deficit to GDP. As you can see, the budget deficit for 2020 and for 2021, which we don't have on this chart yet because the federal government hasn't issued final data, looks just like World War II, and it's the last time the budget deficit to GDP looked like this. However, if you go back before this chart and go back to World War I, you had a similar thing where the federal government issued massive amounts of debt. And whenever the government issues this, we end up with inflation. Inflation is no surprise. It is government engineered to deal with the debt. But the one thing I want to point out before we talk about inflation is US defense spending to GDP. We are in a Cold War with China and Russia. The last time we were in a Cold War in the 70s and 80s, and we were not fighting a hot war such as Vietnam, defense spending to GDP ran between 6 and 8%. In fact, during most of the Reagan administration, which won the Cold War with Russia, defense spending to GDP was almost over 7% and almost 8% most of the time. Today, defense spending to GDP is 4%. It clearly is going to have to rise by a couple of percentage points relative to GDP. And if the government plans to maintain its social program spending, which I expect, then what's going to happen is the government will continue to run massive budget deficits, and the Federal Reserve will continue to monetize the debt. So here is US gross debt to GDP. It is actually now above the level where it peaked in the World War II era. In World War II, it peaked around 119% of GDP. Now it's peaking at about 138% of GDP. It's on a downtrend because of inflation and nominal GDP growth, but I'm not sure how much it's going to go down over the next few years because the government's going to have to expand its budget deficit again to increase defense spending. And by the way, every time the government does this, it raises taxes. The first blip there, it put the income tax in 1909. That was in the original one, was justified by the Supreme Court. We had an amendment to the Constitution that allowed the government to impose an income tax. And after World War I, income tax rates for the highest tax bracket soared. They came down after the war was over and we had paid some of that debt off and we had inflated some of it away. I'll show you that we had massive inflation after World War I. And then when we got into the 1930s and the government needed to spend again, tax rates went up. And especially in the 40s when we had World War II, the government needed all the money it could get from taxes and tax rates went up. They stayed strong through the 1970s when we had to pay off the Vietnam War, and then they dropped since. We expect, since a Cold War is picking up, these marginal tax rates are going to go up, and we wouldn't be surprised if they went up to 60 or 70% over the next 5 years in order for the government to fund itself. It will be impossible, especially given the wealth disparities, for the government to raise taxes on the average person without having a significant raise in taxes for the wealthy. Okay, here is where the Federal Reserve managed interest rates. As you can see, these are short-term interest rates in the 1930s and 1940s. They went nowhere until after World War II. And basically the government, for example, in 1946 had 18% inflation, yet interest rates were only 0.5% on the short end and no more than 2.5% on the long end. This is a chart of AAA corporate bond yields. It'll give you a sense. During World War II, AAA bond yields were below 3% despite inflation consistently running in the 4.5% to 6% range, and sometimes being much higher. Over the decade of the 1940s, inflation compounded at 5.5%, and the price level rose almost 80%. In other words, $1 in 1950 only bought 55% of the goods it bought in 1940. And that's what we're going to have here. $1 in 2030 is only going to buy a fraction of what we were able to buy with it in 2020. In the 1970s, if you go back, there's the famous time cover, which marked the signaled the top in inflation. And what happened then? The federal government had inflated the dollar such that the value of the dollar in 1980 only bought 33 cents of the goods it could buy in 1970. Okay, this is CPI since 1913. You can see the massive inflation after World War I, the inflation during and after World War II, the inflation in the 1970s to pay for the Vietnam War and other war debts. And now you can see inflation is starting to spike upward, and I believe we're entering another period like the 1940s, where we're going to have periodic flare-ups of inflation that effectively inflate away the debt as the government runs a guns and butter policy and pushes economic growth higher. Here's real interest rates for the government. As you can see, in the 40s and 70s, the government had negative real interest rates. Well, actually, this is corporations. I'll show you for the government. And with negative real interest rates, that means when corporations borrow, they're basically borrowing for free. Here's the government, who, as you can see, has run negative real interest rates most of the time in order to fund its debt. Let's talk about the economic backdrop on the economy. We are moving from early cycle to mid-cycle. The Federal Reserve, because of QE, overheated housing. Housing prices, I will show you in a minute, have risen at their most rapid rate since the 1970s because all this money had to go somewhere. And since it didn't go into the real economy because the government shut part of the real economy, guess what? It went into assets. And if you look at where all the lending went, it all went into asset-backed lending. It didn't go to fund the real economy. And it also, besides driving housing prices up, it drove stock market valuations up, which are at levels last seen in the stock market bubble, and before that, last seen in 1929. So here's industrial production. Industrial production had its normal bounce. However, if you note from this chart, it's really gone nowhere since 2000. The reason for this is the WTO and the whole trade sector and what's gone on with China. And we'll talk about that later, but be aware that this is going to change, and the whole trade relationship with China will change for strategic reasons and for reasons of national economic growth. And so major corporations that have basically based their growth off of Asia and having a big presence in China are probably in for a big surprise over the next decade as the US readjusts to a true Cold War and undoes what it did over the last 20 years. Okay, here's US auto sales. Auto sales were down because of the shortage of semiconductor components. There's a massive amount of semiconductor plant that will come on in the second half of this year and will lead to actually a glut of semiconductors in 2023, we expect. Toyota has already talked about their auto production going from 9 million units in 2021 to 11 million units in 2022. So clearly they have visibility that their semiconductor shortage is going to go away. And Texas Instruments came out with its earnings this past week and even said that it expects its ability to supply semiconductors to the automotive and other areas to normalize it by the second half of this year. So we expect you to get a reopening and restarting of auto production. And this will normalize auto production and add to U.S. economic growth this year. but will not be there for 2023. When we look for as running businesses, we would say that what we need to look out for is the lagged impact of the Federal Reserve on 2023, because there's plenty of impact that's going to trail over from 2021 into 2022, whether it's inventory normalization, whether it's normalization of production, that's going to push economic growth faster this year and then disappear in 2023, along with the lagged impact of the Federal Reserve actions to slow the economy. So we expect 2023 growth to be slower than most people expect. Let's talk about home sales. Home sales is another area that got boosted by the Federal Reserve's easy money policy. As you can see here, home sales rose to levels last seen during the housing bubble. This is existing home sales. And they have started to normalize a bit. Mortgage rates, as we'll show in a minute, have started to go up. Every 1% move in a 30-year mortgage rate brings the cost of mortgage debt up 13% on an annual basis, so it will have an impact on prices. When the Federal Reserve drove mortgage rates down from 4% on average, which they were from 2010 to 2019, to as low as 2.5%, they basically added 20% to housing prices. And as you can see, the median sales price of a home exploded under the Federal Reserve's policy. And here, as you can see, the year-over-year price change was the highest since the 1970s. We expect this to cool down quite a bit. In fact, we expect housing prices to go nowhere for the next few years and potentially pull back a bit as interest rates normalize and as people's incomes need to catch up with interest rates. Here's the month supply of homes. As we know, we had a bit of a supply chain issue that affected homes as well, despite the fact that we only delivered 1.3 million homes last year, even though we started 1.6 million homes. Month supply of homes has normalized. From our perspective, this means those other 300,000 are going to show up this year, along with the 1.7 million in permits and starts that are likely this year. In addition, what you're going to have, which has already started, is we had a foreclosure moratorium, and it went through much of the pandemic and was only disappeared due to court actions in the middle of this year. So in the middle of last year, and so foreclosures are starting to come to market. And so what you're going to see is all that supply is going to start to weigh on the housing market. Here's single family permits. And if we look at overall permits, what's happened is overall permits are back to 1.9 million as of December, which is above what we need to replace housing demand. 30-year mortgage rates are up to about 3.68% now. We expect them to ultimately drift up to 4% as the Fed stops buying mortgages completely. But they have had a big part of their interest rate move. Corporate profits, as is normal, have soared. Now, the only issue is that inflation has eaten away a lot of the wages that the individuals have been getting. So we expect wage pressures to continue and corporate profit margins to have effectively maxed out here. We'll show you why a little bit later. And as is normal, corporate capital spending follows corporate profits. Corporate capital spending typically carries the economy in year 3 of an economic recovery, which is what we're entering. And so you're going to see corporate capital spending this year. You're also going to see non-residential construction, which typically bottoms 2 years after recession, and also typically bottoms 2 years before a presidential election, because as we've written periodically in the past, public infrastructure follows the presidential election cycle and typically peaks in a presidential election year. That's because politicians like to get reelected and they like to be able to show their constituents that they did something for the constituents. Okay, and here's your non-residential construction, which is bottoming. And state and local spending, as you can see here, just went straight up. There was no blip from the recession. In fact, state and local tax revenues are at record levels. And so we expect spending by states to continue to strongly inflect upward in most states and to see some state tax cuts in some other states. The reason it went sideways from 2009 through 2013 was because the federal government stepped in during that recession and after the recession to close the hole. And as the federal money went away, the states had to close the hole that they would have had to close earlier. And here's public construction spending, which doesn't look so bad if we look here on a nominal basis. But if we look relative to GDP, public construction spending collapsed during the Obama administration and has not really recovered since. If the monies start getting spent that the federal government has said it's going to spend, which means Congress needs to appropriate the money, not just pass the legislation that it's passed on infrastructure, then what will happen is this will start to normalize. But as you can see, we've had almost a decade of underspending. And if we look on a longer term basis, we've had almost 20 years of underspending if we go back to where public infrastructure spending was in the 70s and 80s. So there's a long ways to go with public infrastructure spending. It's another reason I think the federal government is going to continue spending money. Anyone who's traveled overseas, whether to Europe or even places like Turkey or Asia, knows that the roads are in better shape overseas than they are here. And that's a problem. And so we've clearly underspent on public infrastructure. We're going to have to spend. We're also going to have to upgrade the whole electric infrastructure for electric vehicles, which is something that people haven't thought about. But every transformer on every pole needs to be upgraded to handle the demand load that's going to come by switching the fleet from internal combustion engines to electric vehicles. So I expect public construction spending to rise significantly in the federal government to help fund this whole transition to electric vehicles. Okay, and lastly, I'll finish this about the economy. Here's the yield curve. As I've said in the past, this is the most important economic statistic to follow. It basically leads the economy by about 9 months. As you can see, the yield curve peaked and is indicating slower economic growth ahead. And we clearly expect this to continue to flatten as the Federal Reserve raises interest rates and pulls money out of the economy, probably starting in June, and indicate slower growth in 2023. We wouldn't be surprised if growth slowed below 3% in 2023. And if the Federal Reserve raises rates as aggressively as it said, and it takes money out of the economy as aggressively as indicated in starting in 2022 and running into 2023, we wouldn't be surprised if we came back in a year and we're talking about a potential recession in 2024. So we're not sure the Fed will go there, but we have to watch what the Federal Reserve is doing carefully, because if it squeezes too tightly at the same time that energy prices are going up because of government policies on green energy, then you could easily have a recession in 2024. And this would be the shortest economic recovery since the 1970s and would be mirroring the 1970s. And by the way, what happened after the 73-74 recession was that the Federal Reserve opened the spigot again and you had big inflation. So there's a number of factors that seem to be indicating that we're going to have more inflation later this decade. We have a potential mid-decade recession, and that the Federal Reserve is repeating the exact same policies of the 1940s and potentially the exact same policy mistakes of the 1970s. Okay, let's talk about populism for 2 minutes. I talked about this in the past. Populism is here. If we hadn't had Donald Trump, we would have invented him. And by that, I mean, if we look at the data, it's clear that there is an imbalance in the economy between where incomes and assets reside and where the overall equity in the economy normally is. And anytime historically we have had this kind of imbalance in wealth, an imbalance in incomes, we have had populism going back to the 1800s. So here is corporate profit share of GDP, which actually is at record levels. Under Donald Trump, they had begun to normalize, however, and was headed lower. However, we had the pandemic and the Federal Reserve basically funded the economy in a way, and the government shut down the economy in a way that benefited large businesses at the expense of Main Street, the average business, and the average person. The only reason their incomes didn't collapse was because the government handed out helicopter money to the average person. So there's your helicopter money and the collapse of the economy. And we expect that once we get this data for 2021 and 2022, what you're going to see is that labor share of GDP is going to head back down toward the lows down at the bottom. And this spike was basically caused by the government handing out money to people. Here's real median household income. According to the government, this has risen about 7% over 20 years. In other words, it's risen less than 0.5% a year. However, they are using the stated levels of CPI as per the government statistical manipulations, which show CPI of less than 2% or less than 3% for almost this whole period. If we go from 2000 to 2020 and look at real underlying levels of inflation, and it implies that actual inflation was around 5%. So real median incomes actually shrank over the last 20 years. The only thing that's really true is that during Donald Trump's presidency, which is why he was so popular, real median household income actually rose during his presidency until the pandemic hit. Now, here's the other piece. This is the asset value. At this total net worth share, top 1%. They have clearly been gainers over the last 30 years. And the losers have been the middle class, as this chart clearly shows. And that's because the wealthy, the top 1%, especially the top 0.1%, have much of their wealth tied up in companies and in real estate and in the stock market. And they have massively benefited from the Federal Reserve driving interest rates down, the government running a policy of allowing other countries to displace U.S. production of foreign goods, and the profits that have ensued for corporations. We expect this movie to reverse over the next 10 to 20 years as populism basically demands it. And we are still in an economy that has a democracy. So we expect things to continue to move in that direction and reverse these trends. And this is care of Ray Dalio of Bridgewater Associates, as I've shown in the past. The U.S. net wealth share of the top 0.1% is approximately, and if we carry this forward to 2021, would be above that of the total net wealth share of the bottom 90%. Last time this happened was during the late 1890s, and then again in the 1920s. Let's talk about real asset growth in a QE world. As I said, the Fed threw a lot of money at the problem, a lot more money than it needed to do. It couldn't go into the real economy, so it went into the stock market. And you've had, in my opinion, the most speculation in the market since 99-2000. I lived through the 99-2000 stock market bubble, and I couldn't understand it, the valuations then. And I was proven right on a 3 to 5 year time horizon. And I can't understand the valuations of numerous companies in the market. If we look at Kathy Wood's ARK funds, her premier fund is down 40% since last June, in a reflection of her investing in highly speculative companies that produce no earnings. We think this adjustment is going to continue over the next few years, and we're going to show you data showing how overvalued the stock market is. And by the way, this bleeds into the private equity world, which you need to think about, because public valuations have an impact on private valuations. And if public valuations are massively overvalued and they correct, there's going to be correction in private valuations. As we said, federal real interest rates are negative, and as you can see, they're massively negative. And the only difference between the 70s and today is when we had this inflation in the 70s, the Federal Reserve was not controlling interest rates. So interest rates went up, discount rates went up, and stocks reflected those discount rates. Well, now we've had massive inflation. The Federal Reserve is controlling interest rates, which has kept discount rates at a low level that a naturally functioning market would not allow. Interest rates should really be 5 or 6%, not the 2% or so we see on the 10-year. So here's the Buffett indicator, corporate equities to GDP. As you can see, it's at record levels. Now we have to be a little careful about this because, as we know, the profit share of the S&P that is derived from outside the United States continues to grow. It's now around 50%. It used to be around 20, 22% back in the 90s. So this naturally should drift upward relative to US GDP. But if we detrend it and take out that trend upward, what you see is that the valuation of the market relative to GDP is above where it was in 2000 at the peak of the tech bubble. And this is my favorite indicator, and it's easy to find. Robert Schiller publishes this at Yale University. It's his CAPE, that cyclically adjusted PE. It's a 10-year moving average. It's not a good timing indicator, so don't use this to time the market in the short term. But over the long term, it is an excellent timing indicator when it gets to extremes. And it is at an extreme now, as you can see, well above where we peaked in 1929 at 33.4 and approaching where we peaked in 2000 at 44. We're at almost 40, according to the latest data. And if you want to see evidence of the frothiness in the market, annual IPOs in 2020 exceeded their 2000 level. And in 2021, they did that again. So you've had the strongest IPOs out there since the 99-2000 period. And most of these, whether they came through annual IPOs or SPACs, were companies that didn't make any money and have problems. The other issue that if you look in the market, if you look at a company like Zoom, which we are using today, despite the stock dropping almost 50%, the stock is still incredibly overvalued on a PE basis based on its potential future earnings. And here's a chart from Stifel Nicholas. What it basically shows from these valuation levels, the expected 10-year return on the stock market is approximately 0%. And I wouldn't be surprised if it was 0, or this was done as of late 2021, and I wouldn't be surprised if this was slightly negative over a 10-year time horizon. From the market peak in 2000, it took until 2013 for the market to exceed its prior peak. I think from the peaks we've seen recently, it's going to take a long time for the market to exceed these type of peaks because of the valuation levels in the market. And as another indicator of what's going on in the market, the top 5 stocks in the S&P represent a larger piece of the S&P 500 than they have since the peak of the 72-73 bull market when we had the Nifty 50, which was another group of overvalued growth stocks that ultimately came crashing down because of inflation. For all of those of you in the PE area, there is about $3 trillion of committed capital, which represents more than 15% of US GDP. So there's a lot of capital out there chasing overinflated valuations. It may hold up valuations in the short term because, as we know, if a PE fund does not deploy the money, what happens? It doesn't earn any fees. So there is a definite incentive to deploy this money despite valuations and to try to use capital structure manipulation to make the returns work. Okay, let's go overseas. I am reminded in thinking about what's going on with the total international economic scene of the scene out of Casablanca, which is one of my favorite scenes, where the captain says to Sam, who owns the bar and the casino, I am shocked that there is gambling going on here. At which point the croupier comes up to the captain and says, here's your winnings, sir. If we look at what's gone on internationally with currencies and what's gone on with the WTO, who would be shocked that if a group of countries massively devalued their currencies and then got access to new markets, that they would be able to gain significant market share for their manufacturers? There's no question that that is exactly what happened, and the data support that. So we're going to talk about this. Now, the US, because of this Cold War with China, cannot afford to hand its economic growth to China. So as we will see, the US is going to have to change what's going on. Chinese economic growth is already decelerating on a permanent basis and a secular basis. Chinese will try to fight this, but they have massive problems because of the structure of their economy. 25% of their economy is related to real estate. Any economy where that has happened and real estate has become this big has collapsed ultimately. If we look at China, there are 80 million empty apartments looking for households to occupy them. There are only 540 million households in China. And I think as the US moves to wage economic war on China, that Chinese economies continue to have more and more problems. Now, the risk that we face is when economies like China run into trouble, the way they solve those problems is by finding another outlet for their economic output, and that is typically foreign adventuring through war, or through buildup of their military, or through building military bases all over the world. And so we expect this Cold War and the arms race that already exists in Asia to accelerate and become one of the dominant features of the 2020s. And we would not be surprised if there was an actual shooting war over Taiwan, or if the Chinese tried to grab more of India up in the Himalayas. Please remember that we had the Indians and Chinese have a little shooting in the last year over the Himalayas, where the Chinese tried to grab more and cut off part of India from the rest of India. And the Indians reinforced and sent over 100,000 men up to face off against the Chinese army. Let's talk about the world of yesterday. In 2000, the US was clearly the global leader in economics, well beyond Japan, Germany, UK, and France, and China was a distant number 6. However, because we allowed them into the WTO and they ran a highly mercantilistic policy to favor domestic industry and then export their growth to the rest of the world, they have grabbed massive economic market share. Today, they are the number 2 economy in the world, bar none. They also have the largest share of global exports at up around 14.5%. During the pandemic, they grabbed another 2%. They were down at 12.5%. They grabbed a couple of percent because other countries had shut down their plants. So China, in its infinite wisdom, took the empty ground and grabbed global market share. We expect that this will get pushed back over the next couple of years, and they're going to lose that 2%. Even their economy only grew 4% last year, Q4 to Q4. What you see is that over 1% of that growth came from their export grab last year. So their underlying economy actually grew less than 3%, which is somewhat where we would expect, because they have population growth of less than 0.5%, and their productivity growth is less than 1%. So here's the world of tomorrow, according to the IMF. China will beat the US by 2030, actually by 2028, if you use IMF projections. Now, we're not quite sure if this will happen because we think US economic growth is going to be higher than the assumptions there, which we're only assuming 2% going forward. We think US economy could easily grow 3% plus. And we think the Chinese economy will slow and will grow less than 4% and probably less than 3% unless China builds up its debt even more, which will cause real problems in its domestic economy with massive assets that aren't supported by the returns that they can generate, and the Chinese having massive debt problems. And the US in that case would also spend, and I think so, the distance between the two countries, I think, is going to stay about where it is today because the US needs to do this. The sleeper here is India. India's economy nominally is 3 trillion. However, if we adjust for PPP, it's more like 7 or 8 trillion, and it's growing at 8 to 10% fundamentally. So they easily could be an economy of 15 trillion within the next 5 years. So the one I would watch is India as a surprise grower over the next 5 years and the next economic miracle. Okay, here's the dollar against the developed market currencies. The dollar's up a little, but if we were to look at it on a long-term basis, even if it goes up a little bit this year, it would be in the midpoint of this range where it's been since 1973. At the high end of the range, yes, but it's in the midpoint of the range, so it's nothing unusual. But if we look at the developed market currencies, you can see the massive devaluation in the 1990s, where they basically cut their value over 70% against the US dollar. And then they entered another depreciation when they ran out of room to grow because of inflation. They depreciated their currencies another 25% between 2014 and 2019. Since then, their currencies have gone sideways, but it is expected that the US dollar is going to rise this year. So we would expect that emerging market currencies would depreciate against the dollar this year. I'm not sure how much the US will allow this to occur long term, especially since we are now printing lots of money and running inflation just like these countries. Therefore, their ability to depreciate their currencies and have the real exchange rates depreciate is going to be limited. And here's an example of how undervalued emerging market currencies are. We look at this Chinese yuan number. According to the OECD, if we went back about 3-4 years ago, OECD purchasing power parity was around 3.5 for the yuan versus the US dollar. Now somehow it's magically 4.2. I'm not sure if that's correct. If we went back to 3.5, that 51% would more look like 70% appreciation to fair value. But clearly, things like the Brazilian real and the Indian rupee are massively undervalued. And countries in Africa have used the same playbook. Turkey is trying to use the same playbook, except it ended up creating such domestic economic problems. It basically needed to deplete its foreign currency reserves to defend the Turkish lira because it didn't control the devaluation. And it's having an economic crisis because, as has been announced in the last couple of weeks, it can't pay for the natural gas. By the way, it gets over 80% of its natural gas from Russia, not from Iran. So all this talk about pipeline issues from Iran is not the true story, especially when they're cutting power production by 40%. Here's what we call the whack-a-mole issue. I used to love, when I was a kid, I'd go to places, big amusement parks, and they'd have whack-a-mole, and you'd have to jump on the place where the mole was before it disappeared. Well, when we've whacked on China, we've opened a place for another mole to raise its head. It's called Vietnam. Vietnam's trade surplus with the United States has gone one way, straight upward. And despite that, somehow its currency has depreciated. So the US government has actually issued some warnings to Vietnam. And I wouldn't be surprised if at some point we slap major tariffs on them, because what's being sent to the US is advanced manufactured goods. There's no way it's cheaper to produce them in Vietnam than the United States because they don't use people, unless the government is basically paying for the plant and paying for the land and basically giving people big tax credits so that you don't have to pay any taxes. And that's sort of what's happening. So we expect that this will be addressed by the US government. As we said, here's industrial production just for manufacturing. And as you can see, it has not gone anywhere because of the WTO, and it's a problem for the United States, which we need to fix. I think we are starting to fix that. And if we put these incentives for electric vehicles, which favor domestic production over international production, that will help to start push industrial production upward. And I think we're going to see more tariffs on international goods. Reminds me of a story about free trade from after World War II. Well, there was no such thing as free trade before World War II. If you look at the history of economics, countries always had tariffs against other countries to prevent their goods from coming into your country and displacing your manufacturing. That was just the way things were. But after World War II, we ran out of people to sell our goods to because everybody was poor. So how do we get rid of all this excess wartime capacity? Well, we said, we're going to sell goods to other people, but we have this thing, it says tariffs. We can't do tariffs. So we come up with the concept of free trade, and free trade is good. Well, free trade was good because the US had lots of capacity and the rest of the world didn't because of World War II, and we were going to sell lots of goods to the rest of the world. So we invented this thing, and a couple of people won some Nobel Prizes for all their work in free trade. Well, we come back 50, 60, 70 years later, and guess what? Free trade isn't so good for the US because everybody else built modern plants, and then they protected their industry, and then they shipped their excess goods to the US to help their economic growth. And if we look at Germany, 40% of its GDP is related to exports, 20% outside the EU, including the US, who is one of their biggest trading partners. And so it's not so good for US manufacturing. So we think that over time, we're going to have a re-examination of free trade and look at the truth and the true statistics about what caused the Depression, which was bad policy by the US government and especially the Federal Reserve. But at the time in the 1930s and 1940s, we didn't want to blame the Federal Reserve for causing the real problems in the Great Depression. So we found a boogeyman called Smoot-Hawley tariffs, and we said they were to blame. And the econometric studies have consistently said they contributed less than 1% to the Great Depression. Okay, let's talk about a little bit of hope for tomorrow, because the exigencies of action, in other words, what the United States needs to do for the United States, are starting to dominate policy and policy discussions. And it doesn't matter whether it's Democrats or Republicans, there seems to be a budding consensus on what needs to be done, unlike the last 20 years, which have not been consensus and not been consensus of what's good for the United States. So what's that budding consensus? China is a problem. If China is a problem, then policies are going to be adopted to deal with China as a problem. That's one piece. Company needs to spend more on infrastructure. Okay, we're going to spend more on infrastructure. We need to invest in an EV tomorrow. So we're going to invest more in an EV tomorrow, provide incentives. We're going to rebuild the whole electric infrastructure. Okay, what else do we need to do? We need to spend more money training labor because we need a lot of technical people, because the jobs of tomorrow aren't at JCPenney. Oh, wait a minute, they don't exist anymore. Or at some place like Walmart, because everything is being automated. Even restocking shelves will ultimately be automated in supermarkets. And who knows whether we're actually going to go to supermarkets in the future, although we might, because we like to look at the fresh goods, because we don't want them to send us a head of lettuce that we don't want to buy. But the question is, what goods will be sold in the supermarkets versus being delivered and boxed and sent to your home? That is a big question, and we will see. Okay, let's talk about U.S. gross fixed capital formation. It's a very important economic indicator. It basically says how much capital is the country investing in itself that can earn a return and drive economic growth. As you can see, it collapsed in the Great Recession, what they're calling the Great Recession, what I'm just calling a normal recession, because it kind of reminds me of the 80-82 recession, which I lived through. And it collapsed for a reason. The Bush administration, which engineered the WTO and told companies to go invest in China and help big companies, basically needed to replace that capital spending in the US that was now going to China. So what did it do? In order to get reelected in 2004, it encouraged a housing bubble to keep overall capital investment in the US up. Well, that worked until the country invested way too much in housing, and housing collapsed. And then this downtrend in US gross capital formation had to make up for not only the decrease in corporate capital spending that had been masked, but this overinvestment into the housing sector, and it collapsed to a level that was below any level seen since the Great Depression. Once the housing oversupply had been absorbed by 2015, gross fixed capital formation returned to the lows it had seen in the early 90s and mid 1970s, early and mid 1970s, and then started to grow again and start to normalize. Now, what's the hope for tomorrow? The hope for tomorrow is this has normalized without the government spending on the infrastructure, without the US reshoring manufacturing yet, without there being a whole push to upgrade the electrical infrastructure and build the industries of tomorrow here. So all of that hasn't been done yet, which could really push gross fixed capital formation up to the high end of where it was in the late 90s and also where it was in the 1980s. Plus, oh yeah, we need to spend more money on defense. That's going to be gross fixed capital formation, because the type of things we need for the future are not big battleships. We need lots of small ships. We need lots of missiles. We need lots of satellite weapons. We need lots of things that can destroy satellites, lots of things that can shoot down missiles in the air. We need all kinds of stuff, and none of the capacity to build that stuff has been built yet. So we got to build all that infrastructure here and manufacturing in the United States. So, as I said, federal investment to GDP has collapsed and it needs to go upward. But here's the hope. US IP investment relative to GDP has continued upward. And the US is one of the R&D powerhouses of the world. The problem is we invent it here and then we build a plant in, let's say, Taiwan or Malaysia or Indonesia to produce the goods with this technology. So, for example, and remember I was talking about Vietnam, we had one of the sneaker companies that had a 3D manufacturing plant outside of Atlanta to produce sneakers, and a 3D manufacturing plant in Germany to produce sneakers. And they decided, because Vietnam made it so attractive to build the 3D manufacturing plant, to build that plant in Vietnam and shutter the plant in the US and shutter the plant in Germany. Now, if I'm the US and German government, I would say, you know, what are you doing? You're now exporting advanced manufacturing technology. We are going to say no. And I think that's what the US is going to start to do. It's going to step up its look at technology and start to put roadblocks on companies taking the technology, inventing it here, and then making all the investment overseas. We're going to require more domestic capacity in, for example, autos, which has the Canadians and Mexicans concerned, because 50% of Mexico's economy is exports to the US. And I think there's going to be more trade friction, but we're going to focus on the US because we have to. US industrial equipment investment has been going up significantly now. And as I said, capital spending follows corporate profits. And even if we were to look as relative to GDP, it is sort of bottoming here. It hasn't dropped any. And if we were to increase manufacturing production here in the US, this would go back to where it was in the 1980s and 1990s. And I think that would be a real positive because it would help drive productivity growth. And as we know, productivity growth is at the core of sustainable economic growth, along with population growth, along with the necessary investment into your economy to drive overall economic growth. So if we were to look at the United States, it could have actually three drivers of economic growth: a reshoring of manufacturing. It could have increased productivity as a result, which would drive economic growth, allow more immigration, which would accelerate population growth, which it always has had over time, and I think we will have again. And then the third piece of that would be government infrastructure spending, which would drive capital spending up and continue to drive gross fixed capital formation upward. And here's the magic loop. And you can see why the WTO was bad for the United States. Well, we cut manufacturing investment, which cut manufacturing investment, which lowered productivity growth, which lowered long-term economic growth, which decreased the rate of growth in final demand, which then fed back to decreased need to grow manufacturing. So this needs to be fixed, and this is at the fundamental fix that the economy needs to make. And the only way to make this fundamental fix is by effectively running a more protectionist policy, by requiring certain goods to be made in the US. We think this is going to be done by national strategy and national strategic needs, especially against China. And we're going to move technology production back here, and we're going to require advanced manufacturing to be here. And I think that's going to be a closet way to put protectionist policies in place. And Sophia's, by the way, has started to look very carefully at transactions. I have, in fact, written a couple of letters to the National Security Council, and magically some deals haven't been approved, which would have allowed for foreign investment or transfer of technology to foreign governments, especially the Chinese. So what we've got, which began under the Trump administration, it was recognized by the Obama administration, but it was too late in their administration to do anything about it. The Trump administration has put these policies in place. People thought the Biden administration was going to cut tariffs on China. Well, surprise, surprise, they haven't done that. And surprise, surprise, go back to, I'm shocked there's gambling occurring here. China hasn't lived up to its phase one obligations under the trade agreement with the Trump administration, which should lead to more tariffs on Chinese goods. And so we expect that this trade war with China is going to go up, as well as other things. And and by the way, the reason we've had all this problem on the West Coast is because of internal labor issues and not investing enough on the ports in LA. Here's U.S. manufacturing structure investment. As you can see, it was on a long-term downtrend because the S&P 500 had begun building plants outside the U.S. in the 80s and 90s. In the 80s, it was the miracle of Latin America. In the 90s, they started building plants in Asia, but they couldn't ship the goods back to the U.S., so that was limited. And then once that occurred in 2000, manufacturing investment in the U.S. collapsed relative to GDP. The spike in 2008, 2009 is not an increase, but the collapse in the economy. So as soon as the economy came back, as you can see, that it came back down, and only around 2015 did manufacturing investment in the U.S. start to move upward. I expect this to move back upward to where it was in the 80s and 90s as the U.S. comes to deal with China. Back in the 90s, which was right after the Cold War with Russia, no one would have thought that it was okay to take our technology and export it elsewhere. In fact, in the 90s, the U.S. produced over 90% of the technology it consumed. Today, we produce less than 25% of the technology goods we consume. That's a strategic risk and a strategic problem. Imagine Taiwan gets cut off. How are we going to produce servers? How are we going to produce laptops? How are we going to produce any piece of technology? That's why the US government has been pushing Intel and Taiwan Semiconductor and other major semiconductor manufacturers to build more and more capacity here in the US to deal with the issue that we expect Taiwan at some point to be cut off from the world. And if we have enough capacity here, guess what? We'll magically be able to serve ourselves. We might not be able to export those semiconductor chips to the rest of the world, but so what? We can take care of ourselves. It's why we're also investing in things like magnesium mines. The U.S. has allowed itself to become dependent on other countries for magnesia, which is critical for aluminum production and for strategic metals, for defense goods. We import over 50% of our magnesium, and that is being corrected. The government approved the magnesium mine, and there's also a mine being built up in Canada, which should displace foreign imports, particularly from China. The people who have a bigger problem are the Europeans, because they don't really have magnesium as a metal that they can mine in Europe. They're going to have to come up with a different solution, probably from Africa, and they're probably going to have to put boots on the ground, just like the French have in Africa, to make sure that those mines supply Europe and not Asia. So we think this whole international trading arrangement is going to get undone and redone, and you're going to see surprise alliances show up, such as US-India as part of the Quad, and you're going to see more trade between these alliance partners and less trade with anyone else, and it's going to look much more like the 60s, 70s, and 80s than it looks like today. And on that note, I will take some questions. And hopefully I kept that to an hour. I didn't time myself.
Let's see. Are we unmuted, Zoe?
You're unmuted, Richard. Yes.
Go ahead.
Okay. I'm going to just call on people to ask their own questions. So the first ones are from Bob Zecca. So go ahead, Bob, ask your questions. Other people, send your questions, post your questions in, and I'll then read them or go to you.
Well,
go ahead, Bob.
A couple things. One is, do you think there's a possibility of hyperinflation versus just, long-term inflation going on?
Okay, so hyperinflation is typically what you have in a country like Zimbabwe, right? Where the currency, or in Argentina, where inflation is 50, 60% a year on a regular basis, right? And so the currency becomes worthless. And effectively what happens is those countries, as has happened in Turkey because of the massive inflation. Remember, the Turkish lira. So I was in Turkey the summer of 2020. While I was there, the Turkish lira went from 6.6 to the dollar to 7.8 to the dollar. Today it's at around 13 to the dollar. Okay, so the currency has basically in 2 years been cut in half, right? And so that's on top of the inflation that's going on. So you've had real bad inflation in places like Turkey. What we're going to have in the US, I think, is inflation like the 70s, high single-digit inflation, and potentially a year or two of double-digit inflation like we've had after World War II. People forget that in 1946, when they removed the wage and price controls, right, which had been in place during the latter stages of World War II to prevent goods prices from going up too much. They were already going up like 4%. But when that was taken off, you had an 18% spike in pricing in CPI in 1946. And it was pretty high in 1947 as well, high single digits. So I think you can have high single digit inflation in the second half of the 2020s easily, because the government's going to have to run this guns and butter policy.
Right.
Does that answer the question?
Yes. And so what about the precious metals? Usually, historically, when inflation goes
Oh,
up,
well,
gold and
okay.
silver rise as well.
Yeah. So we've been recommending gold since it's been down around 1,100, and our target, our decade-long target on gold is $4,000. But if inflation gets higher, it could be higher over the decade. It's now around 1,800. It could pull back over the next year as the Fed increases real interest rates. But I would think I would be a buyer of gold for the long term, because the only way out of this type of debt is higher inflation and inflating away the debt. And that's what the United States has historically done since the Revolutionary War. If you go back to the Revolutionary War, the government issued something called the Continental. And there was a saying after the Revolutionary War, because they paid the soldiers in this, not worth a Continental, because the currency became worthless. And there was almost a revolution because of that. The government had to come up with a new way to make good to all the soldiers.
Last question. So with the onset of electric vehicles, which I think is still going to 10, 20 years away because of the infrastructure, how do you think the state and state governments are going to replenish the gas tax?
That is the $64,000 question, to paraphrase a game show, right?
Yep.
So here's the deal. EVs don't pay gas taxes. Let's look at what went on with tobacco. Tobacco taxes have peaked and are going down. Governments needed a new source of tax revenue. They raised alcohol taxes a lot, but that didn't make up the difference because unit growth in tobacco is -6% per year. Okay, so now what do? We have legalized cannabis in most states so governments can tax it. Okay,
Right.
let's cut to the chase. The government needed tax revenue. They legalized something that was illegal so they could create a new source of tax revenue. Okay, now let's talk about electric vehicles. So when you get your electric bill, you know how when you look at your bill, I rented a car once in Fort Lauderdale Airport. What a mistake. There was a quoted price, and then, I have to buy some insurance. But on top of that, total of the car cost plus the insurance, there was 40% in a variety of taxes by the government. So what's going to happen is there are going to be all kinds of electric vehicle taxes imposed on electricity. And so when you get your electric bill at home, now there's going to be a tax on your electric bill to be an electric vehicle tax, right? Or they may do something else. Well, I think it'll be harder to have a mileage tax. I think the easiest thing will be to have a tax on electricity, and everybody pays the tax. Now, what happens if, okay, I don't want to pay the government electric tax. I'll put solar on my roof and I'll just generate my own electricity most of the time, because most of the time I'm just going to work. I get home from work, I plug my car in, I'm done, right?
Mm-hmm.
So, and especially with the new batteries that are coming in 2025. So I think that the government's going to put in place certainly an electricity tax. I think they may put a tax in on those who self-generate somehow, and there'll be or they may put it on the solar panels. I mean, so there are going to be all kinds of taxes that the government's going to invent to make up for the gasoline tax, which is going away, right? Or maybe what they do is every year you have to register your car. They look at your mileage, and based on your mileage, they send you a bill.
Right.
On a per mile basis, right? For how many miles you've gone.
Right.
Okay.
Thanks. Great insight as always, Paul.
Paul, got several other questions. I'm being mindful. We only have another 15 minutes. So
Okay.
Laurie Bernstein Maxwell, ask your question. Laurie, you there? I'll ask it. What do you think is the best investment opportunities given your forecast?
Okay, what are the best investment opportunities? Well, I think ultimately anything that isn't cash, that is a real business. I think real assets are going to outperform paper assets, and you want to own real businesses. And the reason for that is you're starting at such a high valuation level overall for the markets, and there's going to be inflation, and that's going to compress valuations somewhat. And if you go back to the early 1970s, the market didn't really collapse in that sort of early period when inflation went up. Because what the market said, okay, this is temporary, and inflation came back down and interest rates went up a little bit, but they didn't explode. But then when inflation had another flare up and it became clear that inflation was not going away, paper asset values collapsed and real assets continued to appreciate. So I think real assets over the decade, whether it is, owning a piece of property, and property prices are a little overheated here, so you have to wait for them to come down. Owning a business, owning gold, maybe owning some cryptocurrencies, but I'm a little leery of that because I'm not quite sure of the sustainability of the cryptocurrencies. I am as sure of the sustainability of things like stable coins in the banking system, but I'm not sure about cryptocurrencies. But I think traditional hedges for inflation or businesses that benefit from inflation are the way to go. And you'll have to own real businesses and think about where your money is going, because the stock market from here is not going to give, the average person the type of returns they want. And people are going to end up making more from their house than they make in the stock market.
Thank you. Ken Podell, you want to ask yours, which was about Bitcoins? Ken?
Actually, I mean, the two questions I asked, I think, are almost tied together. Do you think the crypto phase that we're in is really lots of money chasing speculative markets?
Yes.
And relatedly, do you think that if the stock market is overvalued, as the early slides showed, do you think this becomes more of a stock picker's market, where maybe the blue chip stocks, individually picked, may be a better haven for somewhat cautious investors?
Yes. So the answer is yes to both. Okay.
Yeah, that's perfect. Thank you.
All right. Sophia Edwards, you have a question? Sophia? All right, I'll ask it. Can Paul comment on whether there are any policies that can address wealth disparity? The world's 10 richest billionaires have doubled their wealth since COVID-19 pandemic started in early 2020, with inequity now reaching outrageous levels, according to anti-poverty charity Oxfam.
Okay. So it's a little beyond the scope of what I have to say, but yeah, there are policies that can be put in place. And a lot of those policies, first, if you have some inflation, it's going to bring valuations down in the marketplace, right? So that's number one. Number two, you need to actually tax large businesses. Almost a third of the S&P 500 pays zero in cash taxes to the federal government. Okay, so you need to do something about that. Okay, number two, you can make stock buybacks taxable. So anytime a corporation buys back, excuse me, could somebody mute? So anytime someone buys back stock, as companies are doing now, they're buying 3% to 5% of their stock back every year to help boost earnings per share and raise stock valuations. That should be treated as either a dividend distribution, or if they're buying back stock, should be directly taxed to the corporation, so they pay tax on buying back stock, right? Because you're returning capital effectively to shareholders, but it's not being taxed. Okay, so I mean, there's a lot of ways you can just start with those couple of things. You can make transfers of wealth to trusts and other things taxable. That, by the way, is in the bill that was sitting from the Democrats to make transfers of assets into trust a taxable event. It used to be prior to the Reagan administration. That was changed in 1983 under the Reagan administration. And since then, you've been able to do tax-free transfers to trust. Prior to then, that was always a taxable transaction at the fair market value of the asset. So that's another thing you can do. I mean, so there's a variety of ways to go at this wealth. You can lower the estate tax. And by the way, if you lower the estate tax limits and you make this taxable, you can change the way you tax stock options and other types of corporate compensation. I mean, there's a whole thing you could do here to go after this wealth disparity. And the other piece of this really is to run a stronger economic growth so that you keep the labor markets tight, so that forces corporations to pay more for labor. That's number one. And number two, you basically say you can't import all these cheap foreign goods that displace domestic labor, and basically those goods have to be produced in the US. And so there's a lot of ways to do it. And all of these relate to keeping the labor markets tight and taxing wealth in a variety of ways differently, and taxing especially corporate options and all kinds of other corporate incentive plans differently in a way that actually produces cash dollars for the government and disincentivizes companies from doing it. And maybe it requires passing some laws.
Okay, we have another question from Don Campbell. You want to answer your question, Don?
Sure. You mentioned something that got me thinking about trade wars, because clearly you're talking about countries putting up, taking back their production and limiting what they do overseas. Trade wars have led to depressions in the past. Do you see any potential for that?
Well, we have been in a trade war with China for the past 20 years. It's just we haven't responded. So I don't see a depression. In fact, for the US, a trade war would be good. The United States manufactures less than 50% of its goods. If it actually manufactured more goods, it would be good for economic growth, and it would be good for wages, because it would drive productivity and increase demand for high-skilled labor. Now, while we wouldn't bring back a lot of domestic manufacturing jobs, there'd be a lot of support jobs that go with those manufacturing plants, and that would be good for incomes. And it has been shown that that will drive up wages in every other part of the economic structure. So, because it would siphon off a certain amount of jobs and tighten up labor markets in a variety of other areas. So I don't think that you're going to end up with the trade wars in the way you would. Do I think we could have a shooting war? Sure, because I think China, ultimately, you're getting a combination of countries, just like you got before World War I against Germany, just like you got before World War II against Germany and Japan. And I think in this case, you're getting a bunch of countries against China, and you're getting a bunch of countries that are going to have to rejigger their thinking about Russia, especially in Europe. And that is potentially going to lead to war. I'm not sure if we're going to have a depression in the US, because the US has a lot of potential for economic growth. If you look at what Taiwan did, okay, Taiwan basically told its people to stop taking the capital and building the plant in China and build it in Taiwan. And you've had an explosion in economic growth in Taiwan because you're building all this manufacturing plant there now. All of a sudden, all this excess real estate got soaked up. So now they've got to invest more in real estate and other parts of the economy to keep up with all this manufacturing production that they're building. So I think certainly a 5-year period, at least, maybe a 10-year period, it would be good for United States growth if you brought a bunch of this manufacturing back to the US. Wouldn't be good for China. China's going to have big economic problems already. And given that they're the largest export economy in the world, I think they're going to have real problems as this gets unfolded.
Okay, we have another question from Ken Podell. Again, you want to ask it, Ken?
Yeah, first of all, I want to thank you for all of your insights. It's been very interesting. These two are also related in terms of government policy and the gridlock that we're seeing. Are there historic precedents? And specifically, I was wondering what you thought about the student loan crisis that we're in. Do you have a thought in terms of how the government should be really looking at this?
Well, okay, I'll talk about, yes, there are historic periods of gridlock, go back to the late 1800s, the last period of populism, and the presidency went back and forth between the parties back then until things resolved into the country having a agreement on which way we should go. And I think we're going to have an agreement on which way we should go with whoever gets elected in either 2026, probably in 2026. I think it's going to be a surprise. It probably won't be Donald Trump, but it will be someone else new that represents where the country needs to go. As to student loan crisis was made by Congress, can be easily undone by Congress. Here's the deal. You cannot discharge student loans in bankruptcy because someone slipped into a bill in the 90s, this thing where you couldn't discharge student loans in bankruptcy to benefit their bodies in the student lending area. Okay. Now, when you were able to do this, guess what? Lenders paid attention to how much debt they would allow the students to take on. So the simple solution is allow student debt to be discharged in bankruptcy. It will take a law passed through Congress, because the original law was passed through Congress. It's real simple. It can be solved that way. And the minute that happens, oh, by the way, there'll be a massive crisis in higher education. So, which there needs to be, because higher education is massively overcharging for what they're delivering relative to the economic results for the students. So I think that, that would be the simple solution. And then the government needs to effectively take over the excess student debt, or give a pathway for the students to get rid of, discharge that debt over a reasonable period of time, such as 5 or 10 years. I mean, when I went to school, right back in the late 1970s, early 1980s, guess what? I made enough money to pay off my student debt, including my debt from business school, by the time I was in my early 30s. You cannot do that today, given the massive level of debts relative to the incomes that students are earning today. Simple solution.
Beacon is the premier executive networking organization serving the Mid-Atlantic region. To learn more, go to beaconforlife.org.